Imagine you're a real estate agent. You're selling high-end properties on a seaside location. Lately, things aren't going great. You still have nice incomes, but many prospects eventually decide not to buy from you. You decide that the solution is to impress your clients to close more deals. How can you do that? You decide to buy an elegant suit, a fine piece of tailoring that gives a professional look to your business, but it doesn't make any difference. You spend more money and time on ideas. You also decide to bring chocolate cupcakes to the meetings and offer a taste of them to your prospects. You've baked them with so much love, but seriously, this won't help you sell million-dollar properties on the beach. We both know that you can do better. One day you're walking in discomfort near the port of your town. You think about all the effort you're putting to make your business grow, but nothing seems to work. At some point, a white flare captures your attention. It's fast, elegant, and it moves like a rocket on the water. Yes, it's a yacht. You were born in that city, and having a yacht was your dream since you were a kid. You always thought only movie stars and rich business owners could afford such an expense. For a split second, you think about getting it. It's a 40-foot yacht, and we're talking about $300,000, but you have savings left and you could always get a loan from a bank for it. But then you shake your head, knowing fully well that that can never happen. It's such a high expense for personal use. Plus, don't forget about Uncle Sam and his taxes over there. He's always knocking on your door claiming for his slice. You decide to stand up and start walking home. That yacht will remain your childhood dream forever. Anyway, your job isn't going great at the moment. You still have to find a way to impress your clients. And wait a moment, did you feel that? Your spine tingles, your eyes are wide open, you have goosebumps. You know exactly what's going on. You're having the best idea of your life. You turn around and you look at the yacht again. You smile, and you know everything is going to be okay. Now, let's skip forward a bit. It's been 3 months since you had that brilliant idea. You're on the deck of your brand new 40-foot yacht, and you're having the best time of your life. It's a wonderful, sunny day, and you couldn't be happier. You're wearing sunglasses, drinking pina colada, while you're handing a pen to a new customer. He's about to sign a contract for the $1 million house on the beach that you just sold him. Thanks to the yacht, you've built a strong brand identity. You're closing more deals, you're making more money, and the yacht is paying the taxes for you. How did that happen? How did that lifetime dream become reality? Stick around to find out the answer, because today we're going to talk about your new best friend, write-offs, also known as tax deductions. Now, if you've been getting value from this video, pause this video right now. Gently hit the like button and go ahead and click the subscribe. That way, you'll be notified of all our inspirational videos just like this one. Done? Great, let's continue. Looking at the previous example, you might have guessed that tax deduction can be a great resource for your business. But what is that exactly? Let's start from the beginning and learn something more about taxes. If you're self-employed or a small business owner, you generate income by the services or the products that you sell. Easy, right? All the money that you make is called total income. Now, a part of this total income is taxed by the government. But how much? Well, it depends. The more money you make, the more taxes you pay. This is called income tax, and it goes from 10% up to 37% or more, depending on which country you live in. Also, some states in the US have state taxes. For example, would you love to live in California? Hollywood, skateboarders, the ocean, and sunny days all year long? Great, add a state tax of 13%. But it's not over yet. If you're self-employed, you have another tax of 15.3%. Now add sales tax, property tax, social security tax, gift tax. We could go on all day long, unfortunately. Hey, I know what you're thinking. Taxes suck. Of course, they help the government build roads, pay teachers, and give a lot of other services to the society. But there must be a way to pay less in taxes and still do nothing illegal. So here comes tax deductions. It works like this. Take all the income that you make with your business. Now subtract the expenses you had for it. You now obtain your taxable profits. Let's go over an example to understand this crucial point. Suppose you run a bakery and a client pays you $1,000 for a cake. It's a delicious one. The government takes a percentage of that $100. Let's say that you have to pay 30% in taxes, so at the end of it, you won't keep all the $100. You only get to keep $70. It may sound unfair, but there's a way around this. Here it comes, your best pal, tax deductions. The thing is that you didn't make that cake out of nothing. You had to buy flour, eggs, sugar, and the package to craft the final product. Who paid for them? You, of course. And here comes the magic. Let's say you paid $20 for all of these necessary supplies. You, as a small business owner, can deduct them from your total income, and this makes your new taxable profit. It means that the government won't take the $100. It'll tax the $100 minus the $20 you spent. Before the deduction, you paid the full 30% of $100 in taxes. That's approximately $30. And now that you've deducted $20 in expenses, you pay the 30% of $80, which comes to around $24. Awesome, right? So you've just saved $6 with tax deductions. Unfortunately for Uncle Sam, those $6 remain in your pockets. Now, apply the same principle for the oven you bake the cake in. The rent you pay for the shop, and all the necessary and ordinary expenses you have to run your activity. We're talking about thousands and thousands of dollars every year that you can deduct from your taxes. This concept is not too hard to understand, but did you know there are more than 2 million taxpayers that overpay their taxes? They literally could save those money legally. They just don't know how to do that. Now that you understand how tax deduction works, what are the expenses that you can deduct? But most importantly, can you also deduct personal expenses? To answer these questions, let's meet Jim and Johnny. Jim and Johnny are both small business owners working in the real estate market, but they have two completely different personalities. Jim has a strong, enterprising soul. He likes taking risks, but he's also a bit greedy. Johnny is a good guy, but he's pretty insecure, and he prefers to play it safe. They both know that it's possible to write off expenses from their taxes, but they act in two different ways. Jim has understood the potential of tax deduction. Actually, he got carried away with that. He goes to his CPA, the personal accountant that manages his taxes, and he just wants to write off everything. I just bought a new jacuzzi, he says. It helps me focus on my job. I want to deduct it from my taxes. His CPA is more like, John, on the other hand, is scared to write off a single expense. I don't know, Mr. CPA, he says, and if I do something illegal, maybe the IRS will audit me. Oh, and by the way, the IRS is that funny guy in charge of collecting your taxes. The CPA, who's a professional and knows the tax code pretty well, makes an example of what Jim and Johnny can legitimately write off. Example 1. Business travels. They both work in the real estate market, and in August there will be a 3-day business conference in Canary Islands. Can they deduct the expenses of the trip to get to and from the Canary Islands? Absolutely, yes. Even more, they can deduct all the lodging expenses during the 3 days at the conference. Can I really do that legally? Says Johnny. Sure, Johnny. Even if it's a tropical paradise and I stay in a beautiful hotel, you can bet on it. At the end of the conference, can I stay 3 more days and still deduct them from my taxes, says Jim? Well, actually you cannot. You can deduct all the expenses for the 3 days of the conference, but if you decide to stay more days because you fell in love with the ocean and the beautiful Spanish girls, you can't deduct them from your taxes. I'm sorry, Jim. Example 2. Home office deduction. Jim and Johnny decide to work from home to save money. Can they deduct something out of it? I surely cannot, says Johnny. Well, actually, you can. Can I deduct my mortgage, utilities, Wi-Fi, insurance, and repairs, asked Jim. Yes, you can. For the whole price? Slow down, Jim. You actually can deduct your house expenses from taxes, but you don't work 24/7 in your house. You also live there for personal purposes. The solution? You can deduct a portion of it. Let's say you live in a 1,000 square foot house. The room that you use as an office occupies 200 square feet. The IRS allows you to deduct the 20% of the total expenses of your house. Example 3. Business mileage. This is a point where many business owners leave a lot of money on the table, especially guys like Johnny over there. Let's say you have to travel 30 miles to go to a meeting with a new client. In 2021, you can deduct up to 56 cents for every single mile that you drive for your business purposes. Does it mean that I have to keep track of all the miles I drive for business purposes? Yes, Johnny. Actually, the best thing to do is writing down expenses every single day. Did you take public transportation, trains, taxis, or whatever? Remember to take 20 minutes a day to write down every single business expense. You can also leave a notepad in your car where you write the initial and final mileage. This information will still be fresh in your memory, so you won't leave a single dollar more on the table for the IRS. I know what you're about to say, Jim. No, you can't do the same for personal travels. I'm sorry, Jim. Other examples of tax deductions? With the same principle, you can also deduct supplies for your business. If you have to buy office supplies like paper, pens, and technology for your business, you can write them off. This also includes PCs and cell phone services. If you buy a new phone, you can write that off. Of course, once again, you have to compute the portion of time that you use it for business and personal use. We could go on all day long, because there are so many things that you can deduct from your taxes. Once again, they have to be ordinary and necessary expenses. Ordinary means that they're pretty common expenses for almost all businesses. For example, meals, supplies, travels, and advertising. Necessary is a little bit trickier. Different businesses have different needs. Remember the example of the bakery? In that case, flour, eggs, etc. were necessary to cook the cake, so they're all necessary supplies. And what about the yacht that the real estate agent bought and then deducted from taxes? Yes, it really happened. That was both an ordinary and necessary expense. It was an advertising investment, but it was also necessary because he used the yacht to impress clients to convince them to buy high-end properties on the beach. What's a better way to do that than with a yacht? So here's the thing. There are more than 2 million Johnnies out there that are overpaying their taxes. On the other hand, who knows how many gyms are doing things illegally? Don't be like them. Choose to be a wise taxpayer that follows the law, but that doesn't leave money on the table. The information provided in this video is not meant to take the place of legal and accounting advice. We just want to let you know that there are things out there that deserve to be known. We suggest you talk with your tax financial advisor if you want to learn more about what you can deduct. Well, folks, that's all for today. I hope you enjoyed and found value in the video. If you did, go ahead and give us a thumbs up and consider subscribing if you're new to the channel. With that said, have a great day, and I'll see you all in the next one.